Well, thank you. That was a great panel. Roger showed great fortitude here. If I go backwards, I'm in the middle of recovering from a new hip, so if I go backwards, I'm going to need an ambulance. When I introduced Andy, I said he needed no introduction, and Debbie Lucas said, since I used it once, I can't really use it again. So, as I mentioned earlier, before I think Bob arrived, sort of think of Bob as somewhat being the David Ortiz of the finance profession and of MIT Sloan with whatever the 600-something batting average that Ortiz had in the last World Series. I'm so pleased to introduce Bob. He's a friend, a mentor, former professor, former colleague, and I think has been sort of an inspiration, I'm sure, to almost every single person in this room. He is the School of Management Distinguished Professor of Finance at the Sloan School. He's also the University Professor Emeritus at Harvard, and previously was the George Fisher Baker Professor of Business Administration and the John and Natty MacArthur University Professor at the Harvard Business School. He was, we were lucky to have him here on the Sloan School from 1970 to 1988, during a period when I was a student. Bob is currently the resident scientist at Dimensional Fund Advisors, where he is developing next-generation integrated pension management solution system that addresses deficiencies with both the traditional defined benefit and defined contribution plans. Bob, as you know, has received the Alfred Nobel Memorial Prize in Economic Science in 1997. He's a past president of the American Finance Association, a member of the National Academy of Sciences, and a fellow of the American Academy of Arts and Sciences. Bob has also spent a huge amount of time trying to translate financial science into practice, and he received the inaugural Financial Engineer of the Year Award from the IAFE in 1993. He's also a senior fellow there. Derivative Strategy named him to its Derivatives Hall of Fame, as did Risk Management to the Risk Hall of Fame. Bob's received the Lifetime Achievement Award for contributions to the field of risk management. He's a distinguished fellow of the Institute for Quantitative Research in Finance and a fellow of the Financial Management Association. And Bob has also received the Nicholas Molodovsky Award from the CFA Institute. So I've actually got to catch a plane to go see a niece graduate soon. If I don't stop, I'll never get to hear anything Bob says. So please welcome Bob Merton.
Thank you. Wow. I unfortunately wasn't here all day, but I got the reports. When I got here this afternoon, they said, you're going to really have to up your game. The speakers here, and I'm not going to name them all because you know who they are, did an outstanding job. Debbie did a great job on the center. And then we listened to this panel. So they were really saying you're going to do it, and you're the last one of the day. I look at it differently. I figured if I quit right now, you've already gotten your money's worth. So I'm completely relaxed as to whether this improves things. What I wanted to talk about today is really some trends in asset management. This is more toward the practicing side. In a certain sense, those of you who were here many decades ago at Sloan, some things haven't changed at all. And the principles and so forth and so on. And so some of the things I'm going to talk about, you're going to say, but I heard that in class a long time ago. But I'm looking at this from the perspective of practice, what's going on in asset management. That's what I chose for my subject for today. And I think there's the two things I wanted to point out to you is one is the notion of goals-based investing, which I believe is going to be one of the important big trends in asset management generally going forward. So I thought I'd talk a little bit about that. And then as a part of that, or as you back out of that, is the question of alpha and superior performance. And I'm going to give you at least the way I like to think of explaining or thinking about alpha in the context of management, and there'll be 3 different times. And I'll talk a little bit about, therefore, how one goes doing it. Now, the process in goals-based investing is before you start optimizing, you first decide what you're trying to do with the portfolio. Now, you look at me and you say, well, of course. But it's really amazing in our profession how many strategies that people follow, how many instruments that are offered, how many things that are done, that they don't have a goal. Now, what do I mean by a goal? Well, I'll tell you what I think are examples of goals. Probably the best known one is asset liability management, liability-driven investing. So you have a defined benefit pension plan, you have the liabilities, you know what they are in terms of what you have promised to pay, okay? And then you manage the assets in some sense to achieve a goal related to those liabilities. Typically, the goal is to be able to pay them. And that's a pretty well-known one, but it's not the only one. And I have some other examples here. A closely related one is if you have a deferred annuity, an insurance company issues, and the board says, no more risk, we're not taking any more balance sheet risk, but you want to issue this instrument, what would you do? You'd have to find an investment strategy on the left side of the balance sheet that would basically offset the risk of that liability. Well, what would you be doing? You would say, our goal is to be able to make those payments on that annuity. And I'll touch on that again. You can find similar things in DC plans, but you don't just have to do it. Goals can be relatively specialized. You have a 2-year-old, and age 18, you want that child to be able to have enough money to go to MIT, tuition, room, and board. Now, you understand what we're trying to do for them is we can't promise they'll get into MIT. But I have a message, by the way, I have a message for all of you. I'm an MIT graduate too, but so I'm in this group. Most of you couldn't get in today. Now, before you get angry with me, think about what that means. Your degree is appreciated a lot because people will say, you went to MIT, you went to Sloan, you got the degree there, you must be really something fantastic. So, going back to this example, the goal is, what does it take to get what we want to do is be able to pay for this tuition, room, and board in 16 years. Very specific, okay? Now, sovereign wealth funds, I'd give you these examples so you understand it's not just from pensions, it's not just from consumer products. To figure out what a sovereign wealth fund should be doing, you first have to ask, what's its function? What's its purpose? And if you were to analyze it, you'd see it sits in the middle of a government balance sheet, which has all kinds of assets and all kinds of liabilities. And the decision as to what that sovereign wealth fund should do really needs to be arrived at by first determining the goal, what you're doing with this sovereign wealth fund, and then optimizing whatever it is. Now, let me tell you what are not goals. And I have a few here. One is, I don't know how many of you know what a target date fund is, but if most of you are probably exposed to in DC plans. And they're thought to be things that you can buy that are simple. That, if you don't know what quite to do for your retirement, you have a DC plan, you buy one with the right date on it. But if you actually look at them, what they say is hold some mix of stocks and bonds for the next 5 years, typically hold a less heavily weighted to equity for the 5 years after that, and they do that for a certain number of 5-year periods out to some date where they stop. By the way, when they stop, they don't really stop. They just stop changing it. The 2010 target date funds are out there still, okay? So what have they done when you read it? They've prescribed a process. They don't tell you why you're doing it. They're not telling you what you would hope to achieve with this. They never mention a goal. Another one which might surprise some of you, I don't consider CPI plus 300 basis points or CPI plus 3% as a goal. I consider that a wish. No, I mean, if you think of markets, markets give us what markets give us. My personal one is 12% risk-free protected against inflation. Unfortunately, that remains on the wish list. But you understand, I mean, first of all, I can always get you CPI plus 3% as an expected return if you don't put any risk constraint. Just, write the risk-return trade-off, find CPI plus 3, there's a portfolio that will do it. So we know that means with some kind of risk constraint. Once you put that constraint on, it's now a wish. Because if the markets can't give that to you, as much as you wish for it, you can't get it. That's not a goal. Okay, so I've told you what, I think you all know what a goal is and what it isn't. And now why is that a sort of a, why do I bring this to you? Well, first I want to very quickly, because of the time, put it in the context of a schematic of investing. And I apologize to all you that are not in asset management or whatever and say, gee, I wish you talked about something else. But this time, that's what we're talking about. And for me, anyway, I find this useful is thinking about how the whole process is done, soup to nuts. The left side is all about creating the optimal combination of risky assets. Just to remind you, the mean variance efficient risky portfolio. Just to remind you, the maximum Sharpe ratio portfolio. We get enough jargon in there, okay? And I will submit that's what most of the asset management business spends its time doing, trying to get steeper and steeper Sharpe ratios. And one of the ways they do that is with respect to various benchmarks is to say we have alpha. And what that really means is if you have an alpha, there's a way of getting a better Sharpe ratio than whatever you're comparing it to. Okay, so there, in terms of resources and time, huge amount is spent on the left side. But that's very important. What you do is you put together a variety of things, and we'll come back to the far left, to create the optimal combination of risky assets. Then you mix it with the best risk-free asset, okay? And that's, that was 40 years ago, 50 years ago. A market was 60 years ago, okay? That's what we're still mostly doing. We pretend not, but if you look, everything's done. There's kind of correlations, or they're in there. Then that gets you to the middle. Now, what about the rest of the right side of the process? Well, the first one, the next one over is called, then you got the optimal mean variance portfolio, but now you combine it with other state variable hedging. Well, those who took 422 or 433 or variance thereof know what I'm talking about, and I'll come back to that. There are other dimensions of risk in the world besides just market risk. And so you need to take account of that. Let me go past that. Where I want to get to is this box. You probably can't see the box. I can barely see it. Can you see the box in the back? No, I didn't think so. All righty. Well, you know why now you all got from me hard copy, because it'd be in front of you. What it says is, after you've gotten the hottest portfolio you could get, you've modulated it for the right risk levels, and you've maybe taken care of this hedging that I'll come back to. Then you have to ask, what are we doing with this portfolio? Because all we've done so far is just optimize, we got the biggest return per unit risk, but we're not saying what we're doing with it. We don't have a goal of it. It's in the next box where we say we alter the shape where the goal comes in. Basically, you use the same engine, the best one you know how, and then depending what you're trying to achieve with the portfolio, tuition, room and board, 4 years, 16 years from now, a set of liabilities for a defined benefit pension plan. Then you take dynamic strategies, you take the best engine, and you mix them dynamically in a fashion that optimizes the particular goal. So you get very different outcomes, ultimately, depending on the goals because of these dynamic changes. But the engines themselves are largely the same ones. Now, you all know, I hope or recall, that dynamic strategies and derivatives, especially nonlinear derivatives, have a one-to-one relation, right? The replication principle. I can always create a dynamic strategy to replicate the derivative. That was the whole foundations of modern option and derivative pricing. But I can also run it the other way. If there's a dynamic strategy you want, I can design a derivative. So whenever I say dynamic strategies, I can also say derivatives, and those are just two different tools for achieving the same results. So I prefer to say dynamic strategies. You know, I'll understand why. In asset management, lots of entities are not allowed to have derivatives, but they're allowed to adjust their portfolio. So we'll adjust the portfolio. Okay, there's going to be one point where I'm going to show you, use that principle of the derivative, but we'll see that in a moment. So it's there where the goals come in, and that's where it is. So the process, if you want to think going backwards from right to left, is you set the goal. You have a set of dynamic strategies that you want to follow with the best risk engine you know how in the risk-free asset, so as to optimize the goal, whatever it is, highest degree of chance of success subject to some risk constraint, or whatever it is that you choose, okay, the objective function. Then you develop the biggest and best engine you can. The people on the left side don't have to know about goals. They're just building the best engines. Like, you build the engine, you might use it to pull out tree stumps in the back 40, or you might use it at Le Mans. Now, we all know about engines. No one engine quite does that, but you understand the principle. If you built the best risk-return engine, you're getting the most for the risk you're taking. You know you've got the best thing, and then how you gear it and do what it is, how you address it. And I find that this is a useful way just in organizing how you think about it. Now, let me go to about goals-based investing, and let me, since I'm trying to get to pay for the rest of the afternoon for your time, is to say why I think this is going to be a big trend and how you could use it, those in asset management, competitively. So I'm going to, as always do, take a hypothetical story. You're out there competing for a mandate. In a former life, we would be going to Terry here at MIT and saying, we would like you to take our fund or whatever we're offering you and put it in a portfolio. But of course, there are other people coming also offering to provide that service. So you're in a competition to convince, let's say, the MIT endowment or whatever to invest in this. So you come armed with your Sharpe ratio. And you have really good, and you have really great Sharpe ratios. But let me tell you what the bad news is. Your best competitor, the best of the, you had some competitors, they're gone, the low ones. The ones that you're actually going to the bake-off with, the really serious ones, they have just as good a Sharpe ratio as you do. Sad to say, but they do. Why? Because there's an awful lot of people out there chasing Sharpe ratios, and they're awfully good, and they hire our students, and our students become, like as you'd have, successful. It's pretty competitive. So you can believe it might get a little hard to be getting always a better Sharpe ratio. So imagine you're there, and you really know that your competitor has as good a Sharpe ratio of you. Now, of course, that's just one point. I wasn't going to mention, what if your competitor has a better Sharpe ratio than you do? So bigger alphas, all right? What do you do about that? But let's stay with the tie. So to illustrate this, the two of us come in, and if you can see this, can you at least see the graph back there, the lines? All right, so the way to think is we started out, we have the 45-degree line. That's the payoff to our best risky portfolio, right? That's the left side of what I showed you. We already got our best engine out there, and we could just offer that. But then the particular client says, yeah, but in addition, that's nice, but I've got a constraint. The constraint is I cannot end up with less than $95,000. Now, you might laugh at 95. You put as many zeros on this as you want. It's just easier for me. I couldn't fit it on the slides. Okay? So they say, we have a constraint, which is we have to have $95,000. We just can't be without it. Now, there are many ways to do that, but I've drawn there what it is. So you can't just have the 45. You have to have the 45, and then you, whoever did this, they say put it on your tie, but maybe I should take my tie off. All right. So now they both do that. Well, so we have to do that. First of all, you see we've transformed the payoff function in a nonlinear way. We know we put in a floor in there, we put insurance in. You all recognize that's some kind of option. That's one way to look at it. You bought a put, okay? So our competitor says, fine. The client says what we do, so we're still in the bake-off, we've got that. But then you come and you say to the client, let's talk a little more. Let's talk about what you're really trying to do with this portfolio. What do you want it for? And you tease out of them, they're trying to do it. It could be the tuition we talked about. It could be paying off the liabilities, whatever it is. You find out what they're using it for, and you discover that what they wanted for, if you could get them $190,000, if you could get, they could pay for it. They could pay for the tuition. They could pay off the liabilities. So and this is an interface with the people, the person, or the entity, the insurance. So you agree, you get the client to tell you, and you get the client to agree, my goal for this is this, and we agree that at $190,000 we can do it. So now what do I do in order to try to beat this competitor to get the business? I say, you know what? I'm going to change the payoff function, and not only going to have the floor up, I'm going to cap the top at 190. Now, many of you know what that looks like. It's called a collar. You know, I'm not talking about the technical aspect. Think of this in the substantive asset. You talk to the client, what it takes is 190. So you change to that. Now, why is this, okay, what have I got from this? Well, the answer is that I'm giving up making more than 190. My competitor's got the top one. That's what she's offering. And I'm offering, she's got a better sharp ratio on me, so it's even, I really have to. I'm offering the bottom one. What is the advantage of mine? The advantage of mine is that my chances of getting the client to the goal are higher. In fact, are likely to be materially higher than hers. Is she a bad investor? No, she has a better sharp ratio than I do. And of course, what does she offer? She says, not only, we have this, but you can get more than 190. How many people here prefer more than 190? So okay. The ones that didn't put their hands up, I assume they think this is a trick. Well, of course, if someone says you can have full retirement plus a boat, even if I don't like boats, I could give it to Eric or one of my friends or donate it, Provided what? We all like more if what? It's free. But this is not free. In fact, of all the audiences I've talked to about this, I am most secure that you know exactly how to value the or more. The value of the more or more on this is precisely a call option on that best portfolio underlying with a strike price at 190 and expiration date at the date in which you meet the goal, the retirement date or the date she starts university. Okay? Think of it in retirement terms. You have a 45-year-old who's going to retire at 65. How many years is that? 20 years. What's a 20-year call option on a reasonably volatile portfolio, which is payout protected, worth? Come on, guys, gals. Well, I'm not going to stick you with it, but you all know you could go to the internet. You could type in Black-Scholes calculator for free. It will download. You stick in the numbers, put any vol you want, and you'll get a number. And that's good enough to make the point. You all know a 20-year call, a 30-year call, a 17-year call, payout protected is worth a lot. It's not 4%. It's more like 25% of the portfolio. Okay? So one way to think of this is the cost of our more is 25% of the portfolio in the example I just gave. It's not always going to be. Well, she's got a better Sharpe ratio, but in terms of getting to the goal, she's only using 75 cents of what the client gave her. I'm using 100. There are no real-world investors that I know of who would want to go into a competition where they got 75 and the second best, I remember I have a lesser Sharpe ratio, the second best has 100. You're not going to catch them. It's too much. That's why I can say with confidence to you, without going through distributions, don't need Gaussian assumptions, you don't need anything, that in terms of getting to the goal, the chances of getting that client to the goal are vastly improved. Is it a magic? No, it's not a freebie. Why? Because the client gives up the or more. But if the client is focused on the goal, and the purpose of the goal is to get there, and you get to agreement, what I'm trying to illustrate more generally with goal-based investing, you're working harder to find out what the client really needs. And if you can find out more precisely what they need, then you can tailor the strategy in such a way that even if you do not have the raw material, you don't have the Sharpe ratio better than your competitor, you can beat your competitor. And I believe this is what you're going to see happen more and more as the competition goes forward in trying to, get mandates and so forth. And that's why I thought I'd spend the time with you today. I think it's something that is pretty big. Now, another example here, which given the amount of time I have left, I'm looking carefully, it gives you the same sense. Remember we talked about trying to take care of a liability, let's say an annuity or a pension fund. Here we see the goal, which is to pay 100% of the pension liabilities from the fund. That's your goal. If you do that, you're done for that goal. Does that mean you're un-American, you're willing to settle for less than the full amount? No. You can have another portfolio that goes for boats. But you want to be laser focused on what it is that this portfolio is supposed to do. And if this portfolio is designed for the goal of being able to pay off this liability, what I'm focused on is paying off the liability. If I've done that, I've done the job. We've achieved the goal. So we get nothing more than the upside than the goal. On the downside, we have a floor. Now, all I wanted to show you is two things. That bell-shaped curve, it could be log normal. It's just a generic 70-30, 60-40, target date fund, doesn't matter. Because you can shift the portfolio just, because target date funds are still 45% in equities the day you retire, no matter whether you've doubled what you need or not. There's no goal in it. So it just keeps chugging along, doing it no matter what. So once again, you see in this thing, you give up the upside, but I can promise you that if you calculate the probability of success, meaning that making the goal, you'll find it's much, much higher by doing this. So that's the motivation, and I just wanted to, I'm done on goals now. I still have 16 minutes. But that's the story I wanted to get across to you because I think this is going to be big. And by the way, it plays to your strong suits of MIT people. Because you can see the dynamic strategies, the working it out. You can even quantify it. You can get the client to quantify it. I mean, I was not, we all know that Black-Scholes, the simple model is, it's very good for accounting. It's because it's easy, but it's not state of the art. The principles are, but the state is not state of the art. But the point is for a client to get an idea of how much or more costs, it's good enough. Just let them download it, put in the vol, put in the goal, and say, how much are you spending with this other more generic strategy in terms of your goal? And it's I think, a very effective way to communicate to people without having to get into probability distributions and fat tails and steady tails and, and all that sort of thing. So now I want to talk about alpha and the optimal combination of risky assets. So remember, I talked to you about the goal. All that's done. Now we're going down to the left side, downstairs, where we build the best engine that we know how. So we're trying to optimize on the Sharpe ratio. And there's been lots of this sort of stuff. I mean, all of you know, and I'm going to throw some jargon out. If you don't know it, it doesn't matter, as you know, a lot of times in my classes. But smart betas and risk parities and all kinds of various things that come out, strategies coming out. And my own view is, and I do this myself, is that it sometimes gets very confusing. And in that case, go back to principles. Go back to basic portfolio theory and start, and everything will come out okay. And things like risk parity, for example, that points out that you have changing risk even if you have a fixed asset allocation because the risk changes. If you use the portfolio model, that does it for you automatically, right? Remember, those of you at least took my class, you had to actually derive the equations. You had variances and covariances in the denominator and means in the numerator. And so the risk got bigger and the mean didn't. You held less of it. And you know what I mean? So it all works. It hasn't changed. But somewhere along the line, someone simplified it and said, let's just talk about an asset allocation as a percentage without regard to going back to the portfolio theory. And you know, on some assumptions it's true, of course. They said 60-40, if we always keep it there, is basically going to be constant risk. And it's not, because the risk of the underlying changes, okay? The other thing risk parity says is that if it's 60-40, the asset that's 60 may only be 5% of the risk of the portfolio because it's fixed income and the other one's equities. Very good. You didn't need that if you went back to your 415, 433 notes or their equivalent, because it's already in the formulas. And the reason I'm saying that, I'm not making fun of people's things, I'm just trying to remind you that you go back. So in that spirit, I define alpha here in the last minutes as starting with that the optimal combination of risky assets as prescribed in the capital asset pricing model you all have had is the market portfolio. And if the asset pricing model CAPM holds, it is the best, highest Sharpe ratio portfolio, and there are no alphas. There are no superior performances, right? But if the optimal combination of risky assets is not the market portfolio is not that, therefore, it is not mean variance efficient, it is not the maximum Sharpe ratio portfolio, then what must be true? There are alphas. That's a mathematical conclusion, not a. So the first thing I wanted to say is let's look at why it is that there might not be any alphas. And I put up here, and I don't even try to read this, but I'll tell you what it's saying. It says, failure of the CAPM implies alpha exists. First of all, empirically, has it failed? Well, remember Fisher Black and Myron Scholes, and we'll have Mike Jensen to come to MIT because he was a good guy, okay? And then Gene Fama and Macbeth, 40-something years ago, rejected the capital asset pricing model, okay? So as an empirical statement, it seems to not be adequate. Now, it's not a wrong model. It's not adequately complete model. All models are incomplete. But the CAPM is too simple to explain the data even at the pretty basic level. But it's not wrong. It's just not enough. And the difference between a wrong model and two incomplete models are very different. 3.14 is a model of pi, right? Circle. Okay. What's a better, less incomplete model? 3.1415.9, right? Notice that the second model, which is included the first one, improves on it, but you didn't have to unlearn the first model. The CAPM, in my view, is that way. It gave you the right insights, but it didn't give you enough of the insights. You improve on it. So it's an incomplete model, but not incorrect. That's important. 4.92, by the way, is just a wrong model of pi. It has no redeeming. Okay? So that's what I mean by incomplete. So where could the failure come? Well, it comes from the incompleteness of the model, the assumptions. All models make them, but what are some of the assumptions? One is that the market is inefficient informationally. You know, people are just faster, quicker, smarter. People have tics. They do things that are crazy, whatever the reasons, that the market prices are just informationally inefficient. I would call that traditional alpha reasons for support. And that's certainly one category. What else could cause that? Suppose that we stipulated the world was informationally efficient, that the market efficiency held. Andrew, I said this is a hypothesis, right? I mean, a hypothetical. Okay, so don't get upset. Could we still have alphas that are inefficient, in a perfectly informationally efficient world? The answer is yes. Why? The second one, market frictions, transaction costs, taxes, spreads between borrowing and lending rates, institutional rigidities in general. Banks have capital requirements, insurance companies, things, endowments have restrictions on what you can own. There are endless numbers of these rigidities, transactions costs, and taxes and accounting and so forth. These frictions can lead to alphas. Why? Because securities will provide more than just a return. They can also provide penalties or relief from the frictions. There may be one way to do the transaction that reduces the frictions relative to another for a particular institution. So a particular institution who wants to take an exposure to a market, it could do it in the cash market, or it could do it in the derivative market. So it could do it through swaps, or it could do it in the cash market. Its capital requirements may not be invariant to which you use. Let's suppose, for example, that they can get better capital treatment with swaps rather than using the cash market. It's possible. In fact, it's quite likely it's happened. Then to that entity, let's call it a bank, it would prefer to hold the swaps than in the cash. It's not indifferent. Why? Because along with all the returns, what else does it get? It gets capital relief. Now, if you don't need capital relief, you could care less. In that case, you might be a good counterparty to that bank, right? Because you don't care, so you use swaps or cash. But if there's enough banks at a point in time or enough institutions who want that capital relief, what's going to be true? It's going to affect the price. How is it going to affect it? It's going to move the price of swaps versus cash, or think of it as futures versus cash or whatever. It's going to move it enough so that people or entities will come in on the other side, and they'll be willing to pay it, not because they're dumb, not because they don't know they're paying more than, quote, the fair value, because they're getting something more for what they do. Another obvious example would be governance. Most of the time you don't pay for votes, right? But sometimes votes are very important. And so if you're holding cash, you get the vote. If you're holding the derivative, you don't. So you can get a window there. I'm just trying to give you examples of what I mean. If you were going to pick an intermediary or a counterparty to be the other side of these rigidities, that is to say, to take the other side of the transaction and therefore alleviate the cost. I'm not talking to you now about getting around public policy. I'm talking about the myriad of all kinds of fixed regulations and rules and taxes in a global environment where what happens in Hong Kong affects Europe and everybody else because we're all working there, that all of these things often cause unintended consequences and costs. So I'm not talking about getting around the rules. I'm talking about dealing with the frictions and costs imposed by those rules, even though they may be good rules. Okay? What would be the design that you would pick? If regulations, rules, and so forth are the cause, they're not the only cause, what kind of institution would be the other side of that trade? It's one that doesn't care about taxes, it's tax neutral. It's one that doesn't care whether it holds derivatives or cash or anything else, right? Because if they're indifferent, they'll take the side that provides the extra return, okay? What is that? In my view, that defines what hedge funds are. The only thing that hedge funds are, they do everything, is that they're lightly regulated. And all I'm pointing out to you is that by being lightly regulated, they're well suited to provide the other side of the transaction and therefore alleviate some of the costs imposed in these unintended ways. So if you're trying to understand the functionality, I mean, that's the idea. So let me not belabor that because I've only got 5 minutes left, okay? But you see, this produces alphas. Now, you wouldn't normally, if I went to a bank and paid them a fee for service, you wouldn't call that an alpha. If I mowed your lawn, you wouldn't, say, gee, that Merton earned an alpha. He mowed the lawn, but we didn't do that. But the interesting thing here is, you see, when you do intermediation not face-to-face like with an institution, but you do the intermediation through the capital markets, which is the way we're talking about it here, you don't get paid a fee. The prices adjust to create a spread in your direction, which is the implicit fee. But when we measure performance, since we don't count that as providing that extra service, we don't take account of it, it bears to be an alpha. And it's a real alpha compared to the base of the market portfolio, but it's a very different kind of alpha than the first one. It's not due to inefficiencies. It's not due to behavioral dysfunctions. It is not due to any of those things. It's due to the fact that you have these costs out there, that the market portfolio is no longer going to be mean variance efficient, okay? So that's, I call that financial services alpha. In my last 4 minutes, and thank goodness it's this audience, the third type of alpha are the other dimensions of risk. And if I had time, and I said, see, I've got to find, there she is, sitting right there at that, you see how I'm pointing to. You. No, don't turn your head. Look at me. No, you. She. Her. Next to him. Okay. I've got a question for you. Which would you rather have? $5 million or $10 million? Yes, you. 10 million. How many agree with her? Now, let me give you the rest of the story. Now you have to listen carefully. Which would you rather have? $5 million, and for the rest of your life, you have one investment available to you. 10% risk-free, protected for inflation investment. A 10% tip for the rest of your life is your only investment. Got it? Or $10 million, and the only investment you have for the rest of your life is a risk-free, inflation-protected 1%. So you got it? 5 million and 10, or 10 million and 1. You only can you have to pick the pair. Which would you pick? You take. Yes, I picked you for a reason. You can figure it out. If you had called on no. If you had called on me, I might have said 10 million anyway. But I knew she was going to pick 5 because, of course, she's going to, expectationally, I mean, be around long. She realizes that at 10% real on 5 million, she can get $500,000 a year for a very long time without spending any principal. At 1%, she could only get $100,000 a year on 10 million. If I had framed it in terms of the income, it would have been obvious too. Okay? So what's the point? The point is, she changed her mind between 10 and 5 as a result of another variable, happened to be the interest rate. What does that mean? That means that wealth is not a sufficient statistic for economic welfare. Because we gave her 10-5. She ended in the second one, she picked 5 over 10. You need to consider other state variables besides that to know your welfare. CAPM never has that because you only live one period. You're like me. You'd pick the 10 always. But in the real world, people live many periods. And therefore, these very other dimensions come in. This is my fastest pass to get across to people what I mean by the other dimensions. You see it's big, too. This is not some little, okay? So there are other dimensions of risk. And you remember, if you took 433, you saw this, like it or not. Eric's laughing. Yeah. And, so you've had this. But if that's there, then what does that tell you? Even in a world with no frictions, no number 2, and no information inefficiencies, you still can have alphas. The market portfolio in general will not be mean variance efficient. And that's the third one. The reason I break alpha this way is not just for entertainment. I believe the sources and type and reasons of those 3 are quite different. So whether you're evaluating alphas, people are offering them to you, and you're saying, why should I believe they have an alpha? And you're saying, what is their comparative advantage? Well, it depends what you think which of those 3 or combination of those 3 it is. Because the comparative advantage for number 2 is very different from comparative advantage for number 1. And the comparative advantage for number 3 is that even if you didn't have any of those things, if you get away from the market portfolio and you can identify the new dimension, and there's a big if there, if you can identify what is the mean variance efficient portfolio, then you can have this third alpha. And that third one is entirely consistent with market efficiency, and frictionless markets. And this is a way, whether you're alpha producer or an alpha consumer, I think you'll find, in terms of testing, in terms of your mindset understanding, I think you may find this useful. If not, I'd fall back on my opening remarks to you, which were, you had a great time, you had wonderful presentations, and if I had done nothing, you got your money and time's worth. So finally, just to conclude, goals-based investing, the future, I think, not the whole future, but an important piece of the future, plays to all the strong suits of what we train people and have for decades at Sloan. Second, thinking about that risk engine and the best building the risk engine. Alpha exists. The question is, what are their types? What are their kinds? Where's the comparative advantage? A sovereign wealth fund might be a great candidate to replace a hedge fund if funding of hedge funds dry up as they did in 2008, 9, 10. Okay? So, for the reasons you can imagine. So, it's a richer world. But having said that, those of you taking classes at Sloan, all of you have, in finance, you say, we knew this decades ago. And here you are in 2014 telling us the same thing. Thank you very much.